So as our moderator said earlier, we've decided to combine the last two panel sessions here into a single session. We're aiming to finish on time at 4:30, so we're going to go through this quite rapidly. We've got sort of the combined ranks of these last two panels together on what is now called the Roundtable on Global Pension Funds Investing in Africa and Institutional Investor Outlook for 2015. So I'm going to very quickly introduce who we have here on the panel and then pose them each an introductory question and then one sort of general question, and then we'll open it up for Q&A. So first of all, directly to my left here, we have Elias Masilela, who until recently was the CEO of Africa's largest pension fund, the Public Investment Corporation of South Africa. To his left, we have Nicholas Fursley, the co-founder and director general of the World Pension Council. To his left, Daniela Klingerbill, who's a principal portfolio manager at the World Bank Group's staff pension plan. To her left, Wale Odioshan, who's the founding partner and chief investment officer of Kurama Capital. We have to his left Ashley Bendel, the head of distribution at African Alliance. To his left, Raphael Stone, a partner at Foster Pepper law firm. And then last but not least, Joseph Boateng, who's the chief investment officer of Casey Family Programs. So what I'm going to do is just kick the ball off here by asking Elias, with his sort of perspective, having recently been head of a big pension fund, but also having had experience as an asset manager, on the board of his country's central bank, a writer, a very broad perspective. So the big question being, what strategic considerations would you recommend for institutional investors looking to invest in Africa in the next 12 months?
I'll be provocative and look beyond 12 months and look at the role of such investors in the African context. And what I would position as a very important aspect in investing in the continent is a psychological change. Gone are the days where, as a private investor or private player, you leave the investment environment to be crafted by politicians or governments. You're supposed to be part of it. More importantly, those of us who manage sovereign wealth funds, who manage pension funds, there is a very clear correlation between the macroeconomy and asset performance of the funds that you manage. And the nature of the funds being long-term basically means you're forced to take a long-term view in any dispensation in which you invest. And being a long-term player, you can therefore not leave your fate to be determined by governments. You need to be part and parcel of crafting that environment in which you operate. Earlier on, there were questions raised about risk associated with the political environments on the continent, regulatory environments, and my view is that those are transitory and they can be changed and molded to make sure that they generate the environment and the returns that you want as a player with a long-term view. You cannot be passive. You need to be active, particularly in the African context where the capital markets are not as deep as what you see in the developed world. You have no choice. The asset allocation has already been determined for you. To a large extent, if you want to play in a credible fashion, you are left to play in the unlisted space. You don't have the shelter, the cover, or the protection of the listed environment. And that means it really changes the game play. What is interesting is that a year or two ago at the Rio Plus 20, a question was posed: what defines stability in an economy? Players or business people from the developed world identified stability as being characterized by transparent and accountable stock markets. Whereas from an African context, stability was about being able to reduce unemployment through job creation, because if you do not do that, then the environment in which you're operating is unstable. It does not guarantee you the returns that you want into the long term. So the link of the commercial case, the economic case, and the social stability case are very key in operating in the African context. Thank you.
Okay, Elias, thank you very much for getting us going there. Nicholas, World Pension Council, you have a global perspective. How does the African pension fund industry fit in the global context?
Well, first, I think we have to see things in broad terms. So Africa, that's 15% of the world population. It's $2.5 trillion GDP, so that's roughly 3% of the world GDP, and I'm speaking under the authority of the World Bank. These are World Bank figures, so that's equivalent to the GDP of New York State and Texas together. And if you look at the main listed, and this is where I will come back later to what Elias said, because I agree completely and wholeheartedly with every word he said, but before switching to that, the conventional wisdom for traditional long-term asset owners, i.e. public and private pension funds, sovereign funds, is first and foremost to focus on listed assets. And if you look at the main, plain vanilla equity index, that's the MSCI World Index, right? And when you have the African continent, which represents roughly 3% of the world GDP, if you look at the components of the MSCI World Index, it's barely 0.91%, the whole of Africa. And if you look at the 1% within the world, the MSCI world, what are the components of the 1%? We'll see that Nigeria alone is a third, Egypt is like 12%, Morocco 9%, Kenya 5%. So all the rest of Africa put together, and I'm excluding South Africa, obviously. So all the rest of Africa, excluding South Africa, together is barely 25% of the rest. So it's a very minuscule blip. And if you're a pension fund manager in Toronto, Vancouver, or London, you have many procedures, many bureaucratic, or you have trustees, basically. You have trustees, risk managers, committees. Every time you make an investment, it has to go through that long process. So you're going to ask yourself a question. Why am I going to spend hours going to my trustees, to my CEO, to my CIO, to invest in something which is barely 0.2% of the index? It's absolutely not interesting. Let me go and buy some shares in New York or London or Paris. Now, this is the conventional wisdom, but I really like what Elias said, and I will conclude with that I totally agree with one point he made, which is if smart money in Africa going forward in the future, especially in sub-Saharan Africa where the growth will be, I think to a large extent we'll have to focus on non-listed assets. That is private equity, venture capital, and infrastructure. And I think these will be incredibly rewarding investments. Obviously there'll be risks, and people need to do their homework, because when you're investing in a non-listed asset class, it's illiquid, so you're really stuck for, it's really for 5, 10, 15, 20 years. So you have to be careful, but I think this is where the growth will come. If you're a Northern Hemisphere pension fund or sovereign fund, I think it's very interesting and very challenging, but very interesting to go in Africa now into private equity or infrastructure.
Nicholas, thank you very much. And I can certainly endorse what the first two speakers have said. We spend a lot of time speaking to asset managers around the world and explaining how if you really want to access the opportunities in Africa, you have to go beyond the listed market. And it's not just a question of scale and liquidity. It's also a question of what sectors in the economy you're accessing by relying only on public markets. So if you want to get a broad cross-section, broad exposure to different sectors in commerce and industry and trade, retail and so on, you need to go beyond the listed markets and look at private equity investing as well. But having said that, Daniela, from the perspective of managing a large pension fund, your particular responsibility is emerging markets and opportunistic portfolio. What are you guys currently doing in terms of investing in Africa?
Well, emerging markets is obviously an important focus for our investment activities, and we've had a frontier mandate in the equity space for quite a while. We've had very good experience in risk-adjusted terms. We believe there is going to be growth in Africa, so we're optimistic on that front. We're looking at, we also have exposure in Africa through our private equity investments, and our colleagues are currently doing due diligence on a couple of private equity investments in Africa where they're focusing on, or the manager's focusing on supporting domestic consumptions by an increasing middle class. So we do see investment themes that can be supported by investments in Africa.
Daniela, thank you. Wale, you are, as I understand it, an investor across a broad set of categories: listed, private equity, advising, investing your own capital, etc. From the perspective of Karamo Capital, what do you see as the most interesting opportunities on the horizon in Africa? Be as specific as you feel comfortable being, whether it's by country, by sector, by theme. I think it'd be useful to sort of share your thoughts on that.
Thanks, Gab. I must say I've been on a few panels. I don't think I've been on a panel at the end of the day with about 10 members, all trying to get some time in. To your question, I think the earlier panelists, Nick and Elias and also Gavin, set the template. We at Karamo were really agnostic about where we invest in. Our focus is really to capture this tremendous growth opportunity in sub-Saharan Africa. And I throw another statistic out there. If you think about the market cap of most of the stock exchanges in Africa relative to the GDPs of the various countries, that market cap to GDP number hovers around 15 to 20%. So we came to the conclusion that Karamo, we will build a portfolio of people, for people, that about 20% of it will be in the listed equities, and then the remaining portion of it will capture in the private markets. Talking about private markets, obviously, people know about the exciting telecoms revolution that's occurred on the continent right now, and how a good number of private equity funds have done extremely well. I think that's moved from, obviously, just cell phone, but now moving more into like just data. I think it's still going to be an interesting opportunity. There's been talks about the, agri opportunity on the ground. We haven't been able to figure out exactly where in the value chain we're going to play right now. But an area we actually find exciting, and I think Bob Diamond mentioned it in his remarks today, is technology. We think there are a good number of interesting companies playing on social media, e-commerce, that are very, very exciting and a place to look into. So we are in the process of really supporting some groups in the technology space, particularly venture. I think people will say venture in Africa sounds even more risky. We think actually it could be very, very exciting. I come from a background of venture. I used to run an endowment upstate New York for a technology school. So I know what venture can do for you, and I know what technology can do for you. So technology will be an area that we find very, very exciting on the ground right now. Key countries for us in technology will be Ghana, Kenya, and Nigeria.
So, Wale, thank you very much, and so far a collective thank you to the panelists for being concise. Brevity is the soul of wit. So, in that vein, Raphael, your law firm has worked on a lot of different investment management projects over the years. What is your experience in terms of what your clients are looking at in Africa at the moment, whether it be type of investment or type of investment structure? I mean, either of those two, I think it'd be interesting to share your thoughts on what the current investor appetite is for ways to invest in Africa.
Well, let me start off and quickly tell you what we do. We represent around 32, 34 U.S. public pension funds located throughout the United States, a third of them on the West Coast, CalPERS, et cetera, Mid-America. and on the East Coast here, all the New York funds, the Common Fund, New York City funds, New York State teachers, et cetera. And we work with them in structuring their investment structure around the world, in particular in alternative investments, which would be a category here, which we're talking about with respect to private equity. I would say this, that a couple of years back, I spoke at this conference alongside my friend here, and I warned at the time that they should anticipate significant U.S. dollars being focused on Africa. I can say today that's going to happen, and it is happening already. We just closed the Carlyle Sub-Sahara Fund, where our client put in approximately $50 million. And I was in San Francisco last month meeting with about 15 U.S. public funds, trying to get what we call in the U.S. 101 basic training on Africa, and just understanding the continent, understanding it's not one country, that it's made up of a number of countries, it's a continent. But I would say that the focus from U.S. dollars in the emerging markets today will be primarily in Africa. Asia, I think we feel we're overinvested. Brazil, we took a shot at, but I would anticipate in the next 2 or 3 years significant interest in Africa. You've got Sub-Sahara, you've got South Africa, and you've got Northern Africa. Most of the issues that we're concerned about is getting in and getting out, obviously. We're mostly tax exempt, so we do worry about some taxes, though, with respect to FATCA, et cetera. But our focus will be Africa. You should expect that we will have significant interest in investing there. And we've already invested, like I said, over $100 million in the last year. I would anticipate significantly more because we're in due process right now on a number of investments there. I don't know if I answered your question, but I wanted to keep it quick.
That's great. Well, thank you very much. Now, Ashley, you're Scottish, so I'm tempted to ask you about the pros and cons of currency union and regional cooperation in the aftermath of the referendum. But in fact, I will resist that temptation. You're here today as the head of distribution for a Pan-African investment bank that's active in 12 different countries. You spend a lot of time talking to investors about their investments in Africa. Where do you see the best opportunities right now?
Well, before I answer that, Gavin, we actually had a very good chat about our perspectives on the Scottish referendum before, and I think we'll keep that off the record for now. With regards to the opportunities across Africa, we were Pan-African Investment Group. We focus on the public equity markets, the private equity markets, the property sector, SME banking, and a bunch of others. My real expertise is the public stock markets across the continent. And to answer your question succinctly, I think in Nigeria being the largest stock market outside of South Africa, people are ultimately waiting for the elections next February, which President Mahama alluded to the incumbent President Goodluck probably winning. And I think we'll probably see a lot of investment come back into the country after that. We've seen the market run up very successfully over the last couple of years, and valuations are no longer as wide. There's no longer as big a discount as we saw previously, which is why larger emerging market fund managers haven't been as active in Nigeria as they were a couple of years ago. I think the Ghanaian story speaks for itself. With the Eurobond and with the IMF team on the ground now, we've seen the currency stabilize, and I hope that 2015 brings some better dollar-denominated opportunities for a number of investors. The banks that you saw on this panel are extraordinarily well managed, EcoBank, CalBank, and Ghana Commercial Bank. It's really a case of investors getting more comfortable now with the macro situation. With regards to Kenya, the market's doing very well, up around 14% this year. Investors have really, the banks are up 50 to 75% on the stock market. And that's really been driven by loan growth and their mobile banking strategies, which are coming through thick and fast. On top of that, other markets that aren't as accessible on the public side, Angola, looking to a stock market in the next few years, provides debt opportunities for now, which are quite attractive. And the likes of Mozambique opening up to oil and gas has got a lot of people excited, as I'm sure many of you are aware. So it really depends on your mandate and depends on what asset classes you can invest in.
Okay, Ashley, thank you very much. Joseph, you're the Chief Investment Officer of Casey Family Programs. I'd be interested in your perspective on, what you've done so far in terms of Africa, how you're looking at the opportunity, time scale, and types of things that you're getting involved in.
Okay. Good afternoon, and you can tell from my last name, I'm not the soccer player or the football player, thank goodness. But I can say something about investing or investments in Africa. We actually have investments in Africa. We're an early adopter. Needless to say, we've also had some experiences and some scars, on the back. Casey Family Programs is a private foundation in the United States which caters to the needs of children in foster care. And the founder is Jim Casey from UPS. The family together left about $7 billion to take care of children, and they call it the disadvantaged children in the US. But in terms of investments, we go everywhere. We are basically geographic agnostic. So we invest in the US, we invest in Asia, LATAM, Africa, and we invest in all sectors, both public, private. Now, if you talk about the African story, we've moved beyond what I call the basic consumer story, that is the eat, drink, wear, wash, and so forth, and looking more at the infrastructure which underlies growth in these economies. But we also are very intentional because growth does not necessarily translate into dollars in my pocket. At the end of the day, when we make these investments, we expect to make a decent return on it. And we strongly believe that given the organic growth, the demand, pent-up demand for services, Wale talked about, the technological change. You can talk about cell phones. You can, talk about the gap which existed if you take the 80s and even the 90s. And currently, there's pent-up demand for many goods and services. And if one were to look at the S-curve, as incomes increase, demand tends to outstrip it. We believe the opportunity on the ground is enormous, and we have investments in all countries to the extent that they're investing on the public side. We have some private investments in real estate, looking at some private equity investments also, and have even considered making investments at the entity level. Now, that's the opportunity. What's the cost? Execution is always a problem. Knowing people who know their stuff, who can make things happen, as opposed to words, because words are cheap. But we want people who really understand what is going on. So having a trusted person on the ground, we find it to be key to success. And one size does not fit it all. So the way we look at stuff here in the US might be different, on the continent. Of course, foreign exchange and the challenges that comes with it, being US-denominated fund is also a problem we look at. But having said that, we believe the opportunity is enormous, and Africa is always going to have a place in the fund. Currently, I'm overweighted in emerging markets, and Africa is a dominant part of it.
Okay, Joseph, thank you very much. I'm just going to add a couple of comments from IFC's perspective. We invest globally in emerging markets about $20 billion a year, and last year about a quarter of that, so about $5 billion, was in Africa. That's up from about 100 million a decade ago. So in the course of the last 10 years, our investments in Africa have multiplied 40, 50-fold, okay? And that is driven not just by the fact that our strategy is to do more in Africa, because that's always been the case. That's been driven by the opportunity to do more. So what we focus on a lot of the time is the pipeline. What is the opportunity? We invest across all sectors, generally in private investments, both debt and equity. And one example alone, I think, kind of illustrates what's changed, and that's in infrastructure. So a few years ago, the amount of private investment in infrastructure, and we only invest in private projects, the amount of private investment in infrastructure was almost negligible. I mean, there were maybe one a year IPPs, for instance, independent power plant projects in the whole continent. Now there are multiple opportunities to invest in private infrastructure projects. Last year, depending how you measure it, somewhere between $5 and $10 billion. Within 5 years, that'll be 20 to 30 billion. And what you need is the three parts, the tripod, effectively. You need the investor appetite, which I think we have. I mean, we've seen a lot more people, whether it's public or private, or large or small, or regionally focused or global, a lot more people focused on looking at the opportunity. And one example of that is just the attendance at this conference today. The second part of it is in a sense, the supply of bankable projects. And I think there a lot of credit is due to the regulatory improvements that we've seen across many African countries in terms of creating an environment in which private infrastructure can actually exist. And then tends to get forgotten in the debate between, well, is there too much capital looking at too few projects, or are there lots of projects that can't find capital? What's often lost in that debate is actually the person, the entrepreneur, the business, the sponsor who's actually putting the project together. You know, bringing together the engineering skills, the sort of the legal input, the financing, getting the regulatory approvals, and so on and so forth. And that is a scarce skill set, okay? So that's one of the reasons that we, as well as investing directly into projects, also invest in private equity firms in Africa, because they, amongst others, are the ones who are actually making things happen on the ground and being able to marry the capital with the actual underlying project. So I would say that that's a very important facet of sort of future growth. We're very encouraged by the improvements in all three of those dimensions in the last few years, and we forecast that will continue into the future. Before I throw it open for Q&A, I'm going to ask one general question, and I'm not expecting everybody to answer, so maybe a couple of answers here. And one of the themes that we've been asked to think about here is the co-investment opportunities, and particularly between international investors and local investors teaming up together to invest in a specific project or company. So question is, what are the recommendations you would have either for the investor in this situation or for the policymaker in terms of how one can encourage more of this sort of international plus local co-investment sort of happening? So does anyone want, we haven't rehearsed this, there may be no takers on this, but does anyone want to jump in and take a shot at that question? Nicholas, you were the first.
I'll try to give an example of, like, suppose you're a North American pension fund and you're going to an African nation to invest in a particular municipal waste management or water treatment. So it's an infrastructure project. And if you look at the public or the government, you know, if it's a municipal water treatment project, the municipality, which is a form of government, is the co-owner, possibly, or the co-investor in that infrastructure asset. You have the local government at the national level who sets the rules, and if there is a legal problem 5-10 years down the road, if you go to court with a lawyer from Seattle, for example, and if you sue the government, well, you have the government who's a co-investor at the local level, is also the judge of last resort, and there's a different branch of government which controls the price of most utilities, be it toll roads, highways, airports, or municipal water treatment. So you also have a public entity which sets the price, because most infrastructure assets are price controlled or monopolies or duopolies. And so there is a risk that if you are a private sector pension fund, and if you're going to Africa, you are facing multi-layered levels of bureaucracy where the government is really everywhere. And if it's a 30-year concession, it's a very illiquid, very long-term, basically, asset class. You cannot just, if you're unhappy, you cannot just sell it and leave the country. So if I had one message to convey to African policymaker, be it at the federal or local or municipal level is to walk the extra mile to reassure foreign investors and really show them in very concrete terms that the legal, regulatory environment is really investor friendly, not only at the level of, speeches, but on the ground, showing them that ownership will be protected, that if there is a problem down the road, courts, judges are truly independent. If you have that in place, I think a lot of capital will flow to Africa because there's a lot of enthusiasm for Africa. The only, or the biggest hindrance is, I think, that multi-layered level of governmental, influence where the private sector pension fund feels that, the scales of the balance are tipped against him. So if they can be reassured that they're really investing in a fair and square environment, I think a lot of money will flow to Africa, to infrastructure and to private equity.
Great. Any other takers on that?
Yeah,
Wale?
yeah, let me actually talk about a live one, which actually addresses part of Nick's concerns. And I think if you're a pension fund all the way, trying to invest directly in a project in Africa is tricky for all the reasons you identified. So the key thing, frankly, is identifying the right partner on the ground and to make sure that the partner can get you through all the local regulations. So for example, the Union Bank deal that Bob Diamond talked about, we were kind of an investor in there. It was a co-investment by a private equity fund that had to raise $800 million. And they were coming up with about $80 million of it. But so what they do, reach out to institutional investors here in the US, some private equity shops that have knowledge in the financial services industry. The local partner, given the fact that they'd done this before and helped really pave the way for all of the local challenges that could happen. And frankly, we have the regulator that approved all of the deal right here in front of us. And that was a success story, and frankly, and we're getting the benefit of it. But I think the key to it, though, for a pension fund is identifying the local partner, and rather than trying to do it on your own.
Okay, Wally, thank you very much. I know Elias has to leave, so I'm going to ask him to jump in on this very briefly, then a brief comment from Ashley. I know he's anxious to say something, and then prepare your questions so we can take a couple of questions before we wrap up here. But Elias.
Thanks. I'll comment as a host. And commenting as a host, I will say domestic capital first, and domestic resources should lead in a co-invested environment. I think it is about time that African resources are utilized in funding African projects. Earlier on in the discussions, there was a discussion about bringing capital from offshore. We have observed that there's a lot of pension funds, African pension funds, sitting in Europe, being managed by Europeans for African interests. And I think that needs to change. We need to repatriate the capital back onto the continent, get it managed by Africans, or even if it's non-Africans, they should be based in Africa, looking after African interests. Currently, there is a potential for a non-consistency in decision-making and interests of the continent. And the only way to align is making sure that the management of the resources is done within the continent. Thanks.
Okay.
Apologies,
Elias, thank
I
you very
had to
much.
run.
No problem at all. Quite understandable. Ashley, over to you, and then we're going to bring in a couple of questions.
Yeah, thanks, Gavin. I would just give some very quick alternative perspective. As we sit here in New York, I think it's important for the various governments to be represented here in the States and to be able to engage US private and public investment more readily. A good example would be the Nigerian consulate here in New York, engaging with African Alliance and myself with regards to making some of their government delegation available to major US investors as and when they're through town. You don't have to travel to the continent to get an idea of what's going on or to be able to engage. And I would encourage governments to do that over here as regularly as possible. Yeah.
Great. Okay, thank you very much. Do we have any questions from the floor? We have one over here. I don't know if there are any microphones that maybe we can lend this gentleman. Yes, there's one coming. Whilst we're at it, any other questions? Yeah, so then another mic over here.
Hello. Yes.
Yes.
I've got a question for yourself. I just wanted to know, based on your understanding and experience investing in Africa in infrastructure, how successful has the PPP model been with regard to funding infrastructure projects in Africa? You know, private-public partnership model. Has it been successful? Are there concrete experiences where it has worked, let's say with regard to road infrastructure building?
Okay, whilst I think about the answer to that, maybe we'll take another
Thanks.
question.
My name is Graham Sinclair, Cinco. The answer I'd like from each of the panelists, and of course yourself as the host, is investors in Africa, do they prefer to go into and thinking of offshore investors, not what Elias is referencing, the local investors? Are you experiencing investors who say, take me to frontier markets or interesting sectors or promising themes, and Africa is a piece of that? Or are your investors, your clients, your widows and orphans explicitly saying, no, we must cover this particular geography and we must cover it in this particular way?
Okay, so any other questions, or is that okay? Okay, so final question over here.
Thank you very much. My issue is on infrastructure. Somebody mentioned that this is a sector where investment is likely to go from 5 to 10 billion currently to maybe twice or three times 25 billion over the next medium term. And that a challenge is actually getting projects developed. So if you're going to leave that to sponsors and the skills are limited there, what can be done to accelerate the project development skills? Can they be transferred? Can they be bought? Can they be nurtured? Or are they just haphazardly arising out of individual sponsors' initiative?
Great. Okay. So thank you for all the questions. So I'm happy to give a shot to the first one. Does anyone else want to take the first? Yes, please, Raphael. Go ahead. Do you want to answer the first one?
I was going to do the second.
The second one. Okay. Anyone want to answer the first one? If not, okay, I'll give it a shot. So PPPs. You know, there is a PPP industry in a sense. There's a whole vast volume of work that's been done in terms of public-private partnerships, sometimes described as, private capital for public services. And essentially, what it boils down to is how you allocate the risk. Okay, and there have been many situations in which, yes, public and private capital have jointly funded the same infrastructure project, but the allocation of risk between the two has not necessarily been, appropriate in either direction. I mean, there are plenty of examples of the government in question giving too much subsidy, and there are plenty of examples of, the government being unrealistic about how much subsidy is required for specific types of project. It's easy to generalize, by the way. Each sector has a slightly different experience in this. Our experience, having not only invested in a lot of PPPs, but we have a whole business in terms of giving advice to governments on how to structure PPPs. That's a whole side of things where at any given moment we're probably advising on about 80 different PPPs around the world, is that one of the lessons we found is simplicity. I mean, it is very easy if you try and define the risk 10 years out into the future and then allocate every single little morsel, that it's incredibly complicated engineering, legal, it's costly, takes a long time, there are lots of things that can go wrong. In the meantime, governments change and maybe have a different perspective. So one of the rules we've learned is that simplicity, and there are some examples now, for instance, in the power generation field with IPPs, where there is a template. And I think that the more that one can say, look, this has been tried somewhere else, it worked, let's try to replicate that rather than reinventing the wheel. By the way, everything I've said applies not just to Africa, but everywhere. Okay, none of this, I mean, both developed and developing world. And I think there are some countries that have had a lot of experience in this, others that have just done one or two. For instance, in North America, Canada has done a huge amount and the US has done very little. So every country has a slightly different experience or skill set in this field. But if there's one lesson, I would say keep it simple. Demonstration effect works. If something's actually done quite well, let's say a toll road, then replicate that, do another toll road in a similar fashion. It's easy to make generalizations, but it's always project by project, transaction by transaction. The solid regulatory framework that we heard from Nicholas and others will always help, of course, and that sort of, in a sense, goes without saying. So that was the first question. The second question, I think, had to do with this issue about, do investors think about Africa as a region or a country per se, or is it more a theme, which Africa may play a part in the theme? Does anyone want to take that? Raphael?
I just would comment, I'd say in the couple up to about 50 deals we did in the last 3 or 4 years, there'd be a piece that would possibly be assigned to Africa. In other words, it'd be global, and they'd have a percentage, 10, 15% South Africa, or 10% in Central America or something like that. Not that they would invest it, but they had the allocation to do that. Today, it's specifically, I'm talking about Africa. We're looking specifically at investing in Africa, not 50% Africa, 50% Asia. It's focused. So I hope that if that's your question, that's what's happening today, at least in U.S. funds.
Okay, Wale and then Ashwin.
Yeah, let me share a different perspective, though. So our investors are generally U.S. endowments and foundations, and the way they arrive at Africa is by trying to invest in regions of the world that were growing really, really fast. So they went ahead and invested in the BRICS, obviously, and not to say that growth necessarily translates to return opportunity like Joseph mentioned, but at least in general, hopefully if you have an investment in a country or region of the world that's growing really fast, you have the wind behind you, and if you can find really good opportunities. So that's how they got to Africa. It's a function of the growth story, trying to capture the growth story. Having been through the BRICS already, now looking for the next destination that's growing really, really fast. So frankly, that also captures the theme approach of investing as well.
Yeah, 2-3 years ago when the larger BRIC markets started to underperform, let's call it, we had the Africa Rising story, obviously 6 or 7 years into its decade. And you saw larger emerging market managers looking for that growth and that diversification. Over the last couple of years, the frontier and African stock markets, from my perspective, have performed very well, right? Not this year, but the 2 prior years, they were up approximately 50% each year. And that in itself has brought interest in specific mandates to invest in sub-Saharan Africa and frontier. It has plateaued slightly. You've seen managers that launched 3 to 5 years ago that have performed well, raising capital, many of whom have now closed their doors to new investment. So we're now really waiting for the next wave to get their 3-year track record almost, and to see that new capital come in. It'll be interesting to see how it unfolds, as the larger emerging markets seem to be performing better now as well.
Okay, and then I think the last question had to do with infrastructure. A gentleman was asking, about, what can we do, what are we doing, and what can we do to help with these bottlenecks, and the sponsors. Can we rely on the sponsors? Do they need help or supervision in some way? Does anyone want to take that question, or is it I'll be the goalkeeper here and or the sweeper, and try and take that one then? I think that one needs all of the above. Okay, I mean, I mentioned in my remarks earlier that one of the reasons we invest in local private equity firms in Africa is precisely because they are making investment projects happen of one sort or another. Okay, not all of them are investing in infrastructure, but some of them are, including specific infrastructure funds. And building a pipeline in infrastructure in particular takes a long time. These projects have long gestation periods. They require focus, they require a skill set, and they require a kind of a long-term perspective from the very beginning. So for people to do that, to devote 5-10 years of their life actually working on one of these projects, they need to know that the funding is going to be there, or at least sort of have a reasonable chance they're going to have support, whether it's from public or private sector. And so sometimes they're asking for a specific commitment. Sometimes they're asking for, the opposite of a commitment, almost like, make sure that we have the freedom to go ahead and actually do this, and there's not going to be some law in the future that's going to prevent us actually going ahead here. Or for that matter, some change in the global regulatory system that makes it more difficult to access commercial banking, lending, because there's a new Basel III sort of regulatory framework that makes banks less likely to invest. And there are all sorts of things going on in the background that, by definition, make it riskier to work on a long-term project, because it takes much longer to get to the point where you get financial close. But I think the key thing for us is this is all part of the kind of the ecosystem. We've talked a lot about this in terms of capital markets. I think the same is evident in private markets. It's not stock exchanges and stockbrokers and securities regulations, but you need the equivalent of that in the private field, whether it be project sponsors, whether it be private equity funders, providers of risk capital of one sort or another, including banks, and both domestic and international banks. So I'd like to leave it there. Thank you very much to my panel here at the last minute for sort of synergizing so effectively. And thank you very much for our hosts for the whole day. Thank you very much.
Doing business in Africa. You can't afford to be without Africa Investor.